Zillow's algorithms show prices holding steady in big cities, but actual closings tell a different story. Zillow charts look smooth, real sales look jagged. A recent investor-owned listing covered in the research had to slash its asking price multiple times before selling far below its 2022 purchase price. And that's not an isolated case. Take Metro Atlanta. While official data shows just a minor dip, MLS feeds reveal active listings have jumped by 254% since 2022. That scale of inventory growth signals distress, not stability. And yet, the headlines keep saying housing is under control. The data nobody wants to talk about. The story behind the glossy headlines looks very different once you open up the data few people discuss. The data nobody wants to talk about is buried in local MLS feeds and Realtor.com figures, and it paints a picture that national averages simply smooth over. Instead of gentle corrections, the numbers show sharp inventory jumps, mounting price cuts, and falling contract values across markets that were once described as immune. Take Phoenix. Wolf Street's analysis puts the city down about 9% from its mid-2022 peak, and Realtor.com reports that 33.2% of active listings are cutting prices right now. On the ground, sellers chasing yesterday's valuations often go through multiple reductions just to get a single showing. Drive through neighborhoods in Gilbert or Goodyear, and you see the signs lined up. Price reduced, seller incentive, and open house this weekend that no one attends. That's not a minor trim in value. It's fatigue settling into a market that used to run on FOMO. Austin's numbers are even more blunt. Wolf Street ranks it among the sharpest decliners nationally at roughly 22.8% down from its pandemic peak. Realtor.com shows about 32% of listings sitting with cuts at any given time. Builders who bet on endless inflows of tech workers are watching subdivisions outside Pflugerville and Leander stagnate. Whole streets display banners offering buyer credits, free appliances, or straight price drops. The lawns tell the story better than the averages, with too many for sale posts competing for the same thin pool of serious buyers. Denver shows a version of the same problem, though framed differently in the press. Official reporting highlights resilience, but Realtor.com logged Denver's active listings up roughly 88% versus its pre-pandemic baseline, and 33.7% of those have already chopped prices. Median list prices are reported down around 3.6% year-on-year. Sellers in condos and smaller homes that once went to investors are now watching them linger for months. Attend an open house in a townhouse community near downtown, and you'll count more cookies on the tray than visitors through the door. The disconnect comes from how headline indices add up averages while leaving unsold or repeatedly reduced homes out of the clean statistics. A national figure showing modest single-digit declines implies stability. But homeowners in fast-growing suburbs see outcomes that swing far more dramatically, 15 to 25% below initial list levels once you add up price chopping to the actual closing number. And those comps weigh on new appraisals. Each cut drags the next transaction lower. Buyers absorb this imbalance differently. Seeing hundreds of listings pile up makes them cautious. Even if nominal prices have ticked down, the abundance of choice encourages waiting. When entire metro areas record 30% or more of homes cutting prices in a single quarter, the logic flips. Buyers hold back because they expect tomorrow's listings will be cheaper. Sellers, realizing this, fall into a pattern of cuts and concessions just to catch attention. The quiet at open houses, the weeks of no offers. These factors never show up in median price charts, but for participants, they define the market. This supply buildup also changes dynamics for professionals. Loan officers wrestle with appraisals that can't justify contract values because nearby comps keep sliding. Real estate agents adjust from managing bidding wars to counseling patients through long marketing periods. Builders struggle most visibly because lowering the sticker price on brand new inventory risks alienating last year's buyers who paid much more. These frictions ripple outward through lending, absorption, and even investor confidence. National outlets can smooth all of this into tidy averages, but the regional MLS stats don't lie. When Realtor.com tracks 1/3 of listings cutting prices in markets like Phoenix, Denver, and Austin, that's not equilibrium, that's distress. And when research documents active listings in Atlanta up 254% from their 2022 levels, it underscores how headline price medians mask the reality of swelling unsold stock. The indices tell one story, but the raw data shows a foundation weakening under visible pressure. That widening divide between the narrative and the field data doesn't just confuse homeowners. It sets the stage for the group of players that moved most aggressively during the boom. And what they do next is going to reveal the market's true direction. Institutional fire sales begin. Back in 2021 and early 2022, the biggest investors in housing acted as if there was no ceiling on prices. Institutional buyers were flooding suburban markets, outbidding regular families with all-cash offers, and treating homes as interchangeable assets. Their assumption was straightforward. Housing appreciation looked unstoppable, tenants were plentiful, and ultra-low interest rates made the math look bulletproof. Instead of picking off a handful of properties, these firms built entire portfolios, sometimes moving hundreds of homes in a single transaction. That strategy only worked as long as appreciation held steady. Once mortgage rates doubled and buyer demand thinned, the spreadsheets no longer balanced. Rental yields weakened, exit assumptions failed, and the models that justified aggressive growth shifted to capital preservation. Research has shown this clearly in recent portfolio data. In some Sunbelt areas, large batches of investor-owned rentals have been listed and repriced down, with discounts reaching into the double digits. One case highlighted in the research involved a Blackstone-owned suburban home that had its ask cut multiple times before finally selling tens of thousands below its prior estimate. For corporations, this wasn't an emotional defeat. It was a rules-based choice. Liquidate and preserve cash before the slide accelerates. This is the core difference between institutional sellers and ordinary households. Families often resist taking obvious losses, holding out for seasonal demand, or even pulling listings off the market altogether. Institutions do not hesitate in the same way because the houses sit inside broader portfolios. As the research notes, those holdings are managed according to performance targets and liquidity thresholds. When returns dip below expectations, the algorithms dictate sales, regardless of neighborhood context. And once those discounted closings print, they become the new comps, pulling valuation benchmarks lower for every homeowner nearby. The speed of these adjustments is reshaping local markets. Consider a street where most owners are still anchored to high pandemic-era values. If even one institutional sale closes at a steep markdown, comparable appraisals have to reflect it. Buyers adjust instantly, lenders follow suit, and surrounding homeowners find themselves dragged down by a single corporate decision. The effect is magnified when funds concentrate in specific neighborhoods because blocks of homes can all hit the market under the same seller, stacking reductions on top of one another. Homeowners often describe this as institutions crashing their neighborhood values. But to the investors, it's simply executing the playbook. Dispose of underperforming assets before capital is eroded further. Remember, this isn't the first time big money operators underestimated the risks of mass housing bets. The ZILLOW Offers program managed nearly the same thing from a different angle, misjudging how quickly properties could be flipped during a cooling market. That misstep cost ZILLOW roughly $880 million before the program was shut down. The point is clear: large-scale housing bets can backfire, and when they do, the need for liquidity trumps patience. The contrast between 2 years ago and today is jarring. In 2021, hedge funds and real estate investment trusts were the ones driving the frenzy, overbidding, waiving contingencies, and making neighborhoods feel like auctions. Now they are unloading in volume, setting new price floors with every discounted bulk transaction. The psychology of endless appreciation has turned into mechanical deleveraging, with little concern for the individuals whose equity gets undercut in the process. For local markets, the fallout is unavoidable. As more portfolios come to market, institutions will continue to post sales below surrounding asking levels. Homeowners can either adjust to the discount comps or wait indefinitely as their listings go stale. Either way, once those numbers update in sales records, they establish a market truth no headline index can erase. The irony is obvious. The very players who helped inflate suburban prices with indiscriminate cash buying are now accelerating the descent with equally indiscriminate selling. Buyers who watch closely see these transactions as the most honest indicators available. They cut through the national averages padded with delayed closings and show what money is truly willing to pay today. Each portfolio sale, each failed rent-to-yield property, marks another step toward recalibrating the market back to levels that actually clear. And unlike hesitant homeowners, institutions won't wait for a seasonal rebound that may never arrive. They exit, they book the loss, and they move capital elsewhere. As this process unfolds, it exposes something deeper. The market is not being steered by soft landing forecasts or reassuring media headlines anymore. It is being reshaped by the raw arithmetic of portfolio management. Algorithms scan the data, measure declines, and execute disposals with no regard for neighborhood sentiment. That's why in communities tied heavily to institutional ownership, equity positions are evaporating faster than national charts suggest. And while those national charts still promise steady curves, the lived reality looks nothing like that. Families comparing their Zillow pages to the closed comps on their street are beginning to see the gap. In the next part, we'll dig into why those neat online valuations seem frozen in time, even as real sales around them reveal a very different pattern. Why Zillow still thinks everything is fine. Why Zillow still thinks everything is fine comes down to how its numbers are put together, and why they often diverge so strongly from what people see happening in their neighborhoods. Pull up Zillow right now, and the graphs look like minor ripples, small shifts down, never anything dramatic. According to the automated outputs, most markets are gliding gently lower. But those charts are only as real-time as the data sources feeding them, and Zillow's model leans far more on confirmed closings than on ongoing listing activity. By the time a deed records at the county level, weeks or even months may have passed since the contract was written. In a slow market, that lag barely matters. In a fast one, it produces serious blind spots. The contrast it creates is jarring. On paper, the downturn shows up as a gradual curve, smooth and muted. On the ground, families list their homes at last year's figures and face weeks of silence. They watch nearby sellers hack $30,000 or $40,000 off just to get a single offer, yet their own estimates still look stable. Buyers can see the price-cutting spree unfolding right on the listing pages. Sellers remain guided by an algorithm that hasn't yet processed what it means. Consider an example documented in the recent critiques. A Phoenix area family listed their 3-bedroom home at $525,000 because local estimates supported the range. Within a couple of weeks, not one offer came in. They dropped to $499,000, then to $485,000. Offers didn't surface until $470,000, where they finally agreed to sell. But in the weeks following, Zillow's posted estimate for the property still sat near $510,000 because the model continued to give weight to older closings from 2023 when rates were lower. While buyers could see the discount necessary to move the property, the algorithm needed time, sometimes months, to acknowledge it. The underlying reason isn't deception. It's a structural design. Zillow itself outlines how its estimates work, and crucially, the performance differs based on whether a home is actively listed. When active listings are available, the system incorporates that asking price and related signals, which improves accuracy. Zillow's own published numbers show median error rates of about 1.9% for on-market homes, compared with around 7.5% for off-market ones. That's a vast gap, and it illustrates why Zestimates tend to shadow actual list prices once a home goes live, but lag behind when it doesn't sell or gets withdrawn. If there's no official transaction and no active list price, the model isn't designed to treat a failed listing as evidence of lower value. Here's a way to picture it. Zillow is a rear-view mirror. It gives a clear picture of the road just passed, but it only updates after the car passes the mile marker. By the time you see the last exit, you've already driven beyond it. That metaphor matches the lag in the charts. A Phoenix condo cutting from $1.8 million down to $1.50 and selling at $1.35 doesn't instantly show up reflected in surrounding estimates. For weeks, the system still suggests values near $1.7 million, creating the illusion of resilience while actual deals undercut it. Another behavior flows directly from the way the on-market input works. Zillow estimates tend to shift upward toward current asking prices when a home is newly listed, because the model factors in that seller signal. That explains situations documented in the Close and Business Insider critiques, where Zestimates temporarily nudged higher when homes hit the market with optimistic pricing, only to require downward adjustments weeks later when the inevitable cuts began. The system is designed for scale, not for micromarket timing, and in noisy, falling markets that difference matters a lot. This creates a unique psychological loop. Sellers often interpret the posted Zestimate as an independent check on their own pricing. If it still shows $500,000, they assume their house is objectively worth it, even while buyer traffic tells a different story. They refresh listing photos, hire stagers, or experiment with presentation tricks, convinced the audience will eventually bite. But as many agents can attest, no angle of photography can hide numbers. When half a dozen similar homes nearby have cut down by 40,000, new pictures won't change the outcomes. Yet optimism clings because the algorithm still reinforces it. That behavior translates into negotiation dynamics as well. Realtors frequently find themselves comparing their recommended pricing ranges with Zestimates that sit noticeably higher. Owners resist lowering their sights because they believe the number represents objective truth. Properties overpriced that way sit on the market, sometimes for months, until gravity forces reductions. By the time contracts close, the Zestimate has begun to edge down, but only after painful weeks of missed opportunities and carrying costs. Even in more prestigious submarkets, this lag shows. In parts of Los Angeles, condos or townhomes that eventually closed $500,000 below starting list prices still registered automated valuations close to original levels for weeks. Buyers reading the landscape quickly understand that the charts don't tell the current story. In fact, many approach Zestimates as contrary indicators, assuming high values signal one more overpriced property about to be discounted. What was meant as a consumer guide morphs, in practice, into a signal of how far reality still has to drag the model down. Put together, the effect is less malicious than mechanical. Zillow is a lagging, not a live market sensor. It was built to handle millions of properties through broad comparable analysis, not to react overnight to a sudden rush of seller cuts. In gradual markets, this is fine. During rapid shifts, it distorts expectations. Owners are reassured by smooth chart lines while buyers see rough waters ahead. And when those two perceptions meet in a stalled listing, the gap between optimism and what a check will actually clear becomes painfully clear. This gap is already shaping choice and strategy. Owners cling to valuations with months-old assumptions baked in. Buyers hold back, waiting for visible reductions to accumulate. Agents navigate between the two, reminding clients that automated values are general ballparks. And every time a corporate seller or cash-strapped homeowner slashes a price to actually close, it resets the comp base for everyone in the neighborhood regardless of what the Zestimate says. So while the charts still look like calm ripples, the lived market feels very different. The illusion of stability has power, especially for sellers, but it doesn't erase the harder math waiting for buyers to solve. And when those buyers sit down with real lenders, the numbers they face don't just reflect home prices. They reflect the changing cost of carrying the debt itself, which has quietly become the largest obstacle in today's housing market. Mortgage rates and the affordability wall. Mortgage rates define the real boundary between people who can buy and those who are permanently priced out. The affordability wall is not abstract. It appears in monthly payments that either fit a budget or collapse it. And over the last 2 years, the numbers shifted so quickly that millions of households hit that wall all at once. During the frenzy of 2020 and 2021, buyers barely considered affordability because mortgage money was cheap. 30-year loans often came in below 3%. In January 2021, the CFPB recorded the average at just 2.65%. At that level, a $400,000 loan translated to a principal and interest payment around $1,600 a month, often less than renting an equivalent home. That single factor transformed ordinary properties into magnets for bidding wars. A modest price increase barely registered in family budgets because every $10,000 higher on the purchase price only tacked on about $40 to the payment. It felt manageable, and so prices accelerated far faster than incomes ever could. Then the foundation shifted. By October 2023, average mortgage rates peaked at 7.79% according to the CFPB. That swing nearly tripled monthly interest costs compared to the trough. Using the same $400,000 loan, the payment jumped by roughly $1,265 per month just from the rate change alone. Taxes and insurance pushed the real total even higher. Families who could have managed comfortably 2 years earlier now face a budgeting cliff. That is the affordability wall. It doesn't matter whether a buyer wants the home. The math makes the purchase impossible. The effect intensifies as prices scale up. A $500,000 house at 2.65% felt safe for middle-class households, an attainable dream with two incomes. At 7.79%, it becomes a $3,500 a month liability before any other expenses. Lenders expect housing costs to stay at or below roughly one-third of household income. Cross into the territory where half of take-home pay disappears into a mortgage, and most buyers cannot qualify, let alone feel comfortable signing. This is why analysts describe the market as locked out. It's not about preferences or hesitation. It's structural exclusion. The NAB's Eye on Housing report gives a clear sense of how sensitive demand is to these moves. Their calculations showed that at a 7% 30-year rate, about 31.5 million households nationwide could afford a median-priced new home. Push that rate to higher peaks, and 2.8 million fewer households meet the threshold. That means a small percentage point difference wipes out entire blocks of eligible buyers. It also explains the eerie silence at open houses. One week, a family can qualify to write offers. The next, the same house becomes untouchable because financing terms shifted. This is the paradox buyers face in 2023 and 2024. Prices are technically falling in many metros, but affordability hasn't improved. A home that dropped 10% might look cheaper at first glance, but with current rates, the savings are wiped out. The payment on a $350,000 purchase in 2021 at 2.65% was lower than the payment on a $320,000 purchase today at 7.5%. Prospective buyers run the repayment math, discover nothing feels affordable, and choose to wait rather than stretch past comfort. That waiting game spreads through the system. Sellers grow frustrated as weeks pass with no offers. Builders push back project starts, staring at unsold inventory piling up. Agents juggle strained conversations with clients who want answers, but the truth always circles back to the same root: rates. Until the borrowing cost falls or incomes surge, the affordability barrier keeps transactions frozen. And homeowners wishing for modest discounts won't see relief, because small price adjustments don't offset the surge in interest. Rent versus ownership calculations highlight this contrast more plainly than any trend chart. In 2021, mortgage payments often undercut rent for the same square footage, which gave renters strong incentives to buy. Today, rents in many markets underprice equivalent monthly ownership costs by hundreds or even more than $1,000. When households do that comparison, the conclusion is obvious: renew the lease. Without clear monthly savings, demand stalls. Some skeptics argue buyers will eventually normalize to higher rates. After all, households coped with 7 and 8% mortgages in earlier decades. But conditions then were fundamentally different. In the 1980s or early 1990s, a 7% loan hurt, yet the loan covered a property valued at only 3 or 4 times annual income. Today, those same multiples have doubled in many metros. Layer historically high prices on top of today's higher rates, and the burden is unprecedented. The past comparisons don't ease today's squeeze. They reveal how different the structure is. The Dallas Fed adds an important nuance. They note that falling mortgage rates don't automatically restore affordability, because lower rates can reignite price gains. If buyers flood back when rates dip, the renewed competition lifts home values again, muting the benefit. That makes the impact of rate declines ambiguous, good for payments initially, but capable of fueling another upward surge if supply remains constrained. For buyers, that means the path forward is not just waiting for cheaper debt. It depends on whether prices continue to adjust or snap back against them. On the ground, the affordability ceiling shapes behavior day by day. Sellers host open houses for a handful of visitors instead of dozens. Buyers who do make offers retain leverage by demanding concessions, inspection repairs, or credit for closing costs. Properties listed too high sit unsold until the owner caves to a number that actually closes. Agents know it is affordability setting these terms, not marketing campaigns or salesmanship. When the math fails at the lender's desk, no pitch can salvage the deal. Households that bought into late-stage optimism now bear the sharpest pressure. Variable loans from 2021 or 2022 are adjusting upward, forcing monthly costs hundreds higher. Those who missed low-rate refinancing find themselves trapped. And if incomes can't close that gap, distressed sales begin appearing as owners surrender homes they can't service. Each one adds to local inventory, feeding the cycle further.